All right, welcome back. It's Jason Walter here. In today's video, I have a special guest that is Neil McCoy-Ward, who is a finance and economics guru. Welcome to the channel.
Yeah, thank you so much for having me, Jason.
Yeah, absolutely. Thank you so much for your time. And so I'm really excited for this video. We're going to talk about the U.S. housing market. I also want to learn a little bit about the U.K. Housing market as well, what we expect in the next coming months, maybe even next year as well. So let's go ahead and dive right in. I'd love to get your take about what do you feel about the housing market today in the U.S. What's your general take about the housing market?
Oh, that's a huge loaded question.
Or I can make it a little bit more streamlined and kind of
Sure.
Okay. So what do you think about a lot of people? I mean, go on to Google search. There are a lot of people are looking for, when is the housing market going to cool off? When is the housing market going to crash? There's a lot of people who have been on the sidelines thinking, gosh, the housing prices are going to be going down. Obviously, they have not been going down. They've been going up, hitting record highs for now the 4 months in a row now. So what do you think going forward? Do you think there's any cooling off period coming or any housing crash that's imminent?
Yeah. I don't believe there's an imminent housing crash. But I mean, before we answer the question, we have to go back. Everything I do, all of my work is based in looking at historical data, history, looking at patterns, looking at everything from, you can go right back. You can go way back, hundreds, if not thousands of years, and you see the same patterns. Maybe not in the housing market today, which is based on the Federal Reserve, if you look at what the Federal Reserve do. But there's patterns with everything. So what's actually caused the overheating housing market right now is very simply super historic low interest rates.
Yeah, for sure.
That's really what has caused it, combined with too much red tape, too much regulation in stopping home builders. I mean, where you are in your sort of state, if you look at Los Angeles and look at how difficult it is to build anything at all in Los Angeles, that's a perfect example. Why are you getting these crazy high prices? Yeah, of course, it's jobs and it's the money in that area, but it's also the restrictions that you have on home building there. So there's your two main things, historically low inventory levels as well. This is another thing that's causing this. And it's interesting because in 2017, 2018, I created a model. A lot of people know about this model. And I said in 2021 or late 2020, the housing market is going to see a correction. And I thought it'd be between 18 and I don't know, maybe 30% correction, something like that. And of course, this was, and some people say, broken clocks, all that sort of expression stuff. But the fact is, I always said 17 and 18, it will happen at the end of 2020, early 2021. And it was on track all the way through. I was still confident it was going to do that. So what actually stopped that was this whole pandemic, this whole crisis. And with all the new, currency creation, I don't call it money creation because it's not money, it's currency. All this new currency creation by the Federal Reserve just thrown into the banking sector, the banking system, with these, low interest rates, and then all the inventory, the shock to the system, the mass migration, all of this obviously is going to cause this situation that we're in right now.
Yeah, for sure. Definitely true. I think in late 2018, if I'm not mistaken, I think interest rates were rising quite a bit in the fall and winter of 2018. And that's when the housing market was really cooling off. I think rates were approaching around 5% during that time. And then they fell off after that. And then obviously when the pandemic hit, the Fed decreased the federal funds rate to 0%. And then that decreased ultimately mortgage interest rates to near record lows or record lows. I don't know how many times we hit record lows in 2020, but we're seeing that now too. So what I'm really interested in too, is I've been saying that interest rates are going to be approaching like 3.5% towards the end of the year. And then look where we are right now. I think yesterday, I think the average was like 2.86% and the record low was 2.75%. So we're like back into very, very close to record low interest rate, even levels here. And it's going to be interesting to see what the rest of the year plays out to be, because there's not a huge increase of people listing their houses for sale. There's not a huge dropout there. So yeah, I'm not personally seeing anything right now that's like saying, hey, this is going to be a housing market crash.
Well, let me just mention one point on those interest rates. So I'm seeing a lot of YouTubers, who specialize in the housing market. I'm not including you in this, Jason, but a lot of these people now that they're saying that because of the interest rates staying low, there won't be a housing market why interest rates are this low, a reduction or a crash. Now, let's put the word crash out of the picture and just use the word reduction or slowdown. Yes, that's one part of it. That's one variable. But for everyone that's watched my videos, they'll know and understand that there is always a cap to any housing market. So the cap is either, interest rates go up and that forces down, 1%. We know historically it will cause a reduction of anywhere from 8 to 12%. Just take 10% as an average. We know this. Now, of course, that tapers off once you get past 3%, 4%, it's not quite, that same variable. But we know this, we have the historic data. But there's another point to it as well, and that is affordability. So you could go down to, 0.5% interest rates, 0% negative rates. It doesn't mean that people are going to be able to still afford a home. So let's say you have a house that's 200,000, and then next thing, it's rising with 20% rise in a year, and, et cetera. Well, eventually that house goes from 200,000 to 250, and let's say it goes to 300,000. There is a cap because people don't buy a house with cash; they buy it. And again, this is also another fallacy. People say, "Oh, because it's on a monthly payment, there'll always be affordability." No, there won't. There's always a cap in terms of a salary. Your salary has to meet the increase in the housing market. If it doesn't, then you're going to hit a cap of affordability.
For sure.
And yes, you can keep doing the 5%, 2% down pay and all that, but you're still going to reach a cap. And I don't think we're too far off. It can still keep going for a while yet, but it can't keep going for 5 years. You're going to reach a cap. No,
definitely true. That's one thing I really love about your take about the housing market and on your YouTube channel, by the way, which you have 286,000 subscribers, maybe. I think you're too shy when we started this video, but yeah, around 285,000 subscribers. So if anyone who's watching who's not subscribed to Neil's channel, please subscribe to his channel. A lot of great information out there, way better than my videos. But I really like your take on the housing market, because when you look at some people's videos and then their opinions about what's going to happen in the real estate market, it's a lot about like, this is what I feel is going to happen. This is what I'm going to be like forecasting based on no data whatsoever. And so you're watching these videos going, where are they pulling this data from? Because I'm like you, I'm an analytical person to begin with. I don't know about yourself, but I, analyze the data and try to figure out, what's the temperature of the market? Where is it headed? And so that's I think we kind of are in line there, seeing eye to eye, because I've always told my viewers on my channel over the past several months here is that I believe if we're going to have any correction or slowing down of the housing market, it's going to be to affordability issues. The federal funds rate is going to be staying at 0% in the near term into potentially next year or the year after. And so interest rates are not going to be shooting up. And so you don't have that factor where if we had a whole bunch of people with adjustable rate mortgages and interest rates were increasing every month, then holy cow, that's a recipe for a disaster. But we're not seeing that. In addition, we're not seeing a whole bunch of builders completing houses and being permits pulled like crazy. They actually had a decrease of permits pulled in June. So we don't have like this massive increase of inventory. We don't have a massive increase from forbearances, people who are listing their houses for sale. We're not seeing that in mass numbers. And so if there's so many variables, like you say, to the housing market, it's not just if interest rates stay low, home prices are going to increase forever. It's simply not the case, because when we look at people's income levels, they have not increased 25% on average compared to a year ago. In the meantime, home prices have increased, over 20%. And so at some point, you're going to have some sort of affordability where, A, you're not going to be able to afford the down payment, which is in United States is in general 3.5% to 3%, and then also the monthly payment. And then the other side to it too is that mortgage rates are so low right now. I mean, how much lower can they really get, right? 2.75 is the lowest ever, and so you're not going to have that bailout from a decrease of mortgage rates, because when that happens, home prices go up. Yeah, that's a double-edged sword. Yeah, it's a difficult one. You said a lot there, so let me see if I can unpack any little points. Next time I'll try to speak a little bit shorter. Oh, no, you're fine. One thing on the interest rates,
there's a correlation with some of the things that are going on right now and what actually happened in the 70s in the United States. So again, I don't just read normal history, I read economic history as well. I like to see all of this, and my brain then forms these patterns and links it. Yeah. Now, one of the big shocks that actually occurred in 79 through to 81 was Paul Volcker, who was Fed chair at the time. And he just went crazy. You know, it was like 11% in, I think it was 79, and he just bumped it to 20% in 81. And that was a huge shock to the system. And a lot of people say that could never happen today. It's impossible. I don't really like the word impossible. I think it's highly unlikely, but I definitely factor it into my calculations. I don't just omit that from my calculations. I actually have that in there as a potential variable that could happen. And then I basically, with all of my models, I have a set path that I sort of follow, and this is what I think is going to happen. But then I have all these sort of other paths all over the place, which could happen as variables, which is a lot of work, because you then have to update as soon as you get 3-4 weeks in. You have to update all the other paths, and you're like, oh, it's so much work to do.
Yeah.
But you know, I think personally the way it will go is if we look at what happened with the 2008 crisis, and I'm not talking about the housing crisis, but the recession itself. Yeah. One of the things that we could see, and this is what I think is most likely to occur, but then we have the variable with the CBDC, central bank digital currency, which they want to implement. I mean, that is going to, it's so far out of most people's realm of understanding that it's extremely difficult to even quantify at this stage. But there's a lot of things that could come in with that. One of the things that I saw in one of the white papers was around social credit scores. And this is actually something that's been proposed. Social credit scores around who can have a house, who can get a mortgage, and things like that. So again, these are the wild cards that I'm going to put to the side, but it's still something we have to look at. Could we see an interest rate rise? I think probably what's mostly likely to happen in 2022, and I don't know when in 2022, it could be early, it could be mid, it could be late. I think what's most likely to happen is a tapering of the QE, the quantitative easing, and therefore a tapering of the purchasing of mortgage-backed securities, MBS, which anyone watching, you can find this on the Fred of St. Louis. That's probably the best website to go to. And last time I checked was 3 weeks ago. The Federal Reserve owned 53% of all the mortgages in the United States. I mean, this is crazy.
Wow.
A private
has that number changed much? Has that number changed much? I personally don't follow that. And so has that number changed much over the years or months?
Yes, it has. So during this crisis, it has exploded up. Now, what they tried to do a couple of months ago, maybe a month, I don't have the graph in front of me, so I can't say 100%. But what they tried to do was taper downwards. And what happened when they tapered downwards, if you look at the correlation with the markets and the bonds and everything else, it didn't work. So they went back and they purchased more again. Now, that's going to be very difficult for them to stop doing. Now, for the viewers that don't watch my channel, the Federal Reserve is a private institution owned by shareholders. It is neither federal nor is it a reserve of value. So something to be aware of. Again, a lot of people don't like me saying this in the US. They get upset when I say this, because they say you shouldn't tell people this, and it could cause all these problems or whatever. But look, it is a fact. The Federal Reserve has been going for a long time. Before that, it was called something else, and then the Bank of the United States, and all these sort of things. There's a really good book, The Creature from Jekyll Island, which everyone should read, and it talks about how this happened, and Lords of Finance, another good book. It's worth understanding this, because when you understand the patterns and you understand the history of how everything came about, you really start to understand how everything comes together, and you can have a good forecast of what will happen in the future. So do I think interest rates will rise? I think it's unlikely. I think they'll just stay quite low for, at least another 6 months, a year. I think they're going to probably try and taper by 10 billion per month in terms of their asset purchases until they get to, I don't necessarily think it's going to go to zero, because the inflation, deflation, stagflation, slumpflation, everything that's going on right now. But there could be a shock. You could see a shock to the system, or with the CBDC, they could do something. You could see two currencies running side by side, the US dollar with the US digital dollar, as it were. There's a lot that can happen. It's very, very complex.
It's definitely true. I mean, there's so many factors involved when you're trying to, like, let's say, predict interest rate changes or the housing market changes. I mean, no one knows exactly when interest rates are going to be increasing. At some point they have to. No one knows how many people are going to be listing their houses for sale. So it makes it very, very challenging to predict the housing market. And so, yeah, especially with interest rates too. I mean, the Fed said they're going to be raising the Fed funds rate, but inflation's so high right now. So what's your take on that? Do you think that this inflation truly is just a small moment in time that's going to pass? Or do you think it's going to be more of like a long-term issue?
I've said for the last year, and I mean, I think it was April or May 2020 when I first started talking about this. And I said, and I disagree with a lot of people who say QE doesn't make it into the monetary supply and all this. I disagree with that. It does. And you can look right back to even the likes of Milton Friedman and others. And the models really have remained unchanged on inflation. When you create mass amounts of currency, different to money, mass amounts of currency, and they go into the banking sector. Yes, okay, you've got a deposit account at the Fed and you've got the bank. Like, I'm not even going to get into all that because it's a very complex area and there's a lot of arguments which we won't get into. But some of that QE does make it into the currency supply. It does. And when you give people stimulus, this is what I don't get about some of these YouTube economists. They say, oh no, the QE doesn't make it into the currency. None of it has made. How can you say none of it has made it into the currency supply when the government gave people stimulus or furlough or whatever? Of course it's gone into the currency supply. Now what happens is 12 to 18 months after that, you have the inflationary effects. Now, what you've got is the inflationary effects of the QE and the printing the stimulus, but you also have the inflationary effects of the supply chain breakdowns right now due to lockdowns and everything else that's going on. So I see it 50-50. I see half the inflation as transitory, half of it I see as ongoing. Now, here's the thing that people never sort of explain properly around the linguistics, shall we say, of the word transitory. Transitory, I mean, we can break it right down to the base level of it, but really simply, it's a transition. I'm saying it's a transition. Transitory inflation doesn't mean that prices are going to go up and then they're going to come back down. No, you're transitioning to a new period. And this is the distinction that no one ever makes. You are transitioning to a new period. And that new period is higher inflation. It doesn't mean it's just going to keep going on and on and on and on and on and on into infinity. And I personally don't think that. I had Peter Schiff on my channel. We had a big argument about this. He thinks, hyperinflation and whatever. I don't see that. I see actually more likely we're going to see deflationary effects. And you only have to look back at that video I made, 18 months ago now, and it's played out almost perfectly, which is probably
interesting.
Yeah, with the stagflation. We've had the inflation. We've also, I think we're going to see deflationary effects coming into the market. So we are going to see this period of stagflation is what I think. And I haven't really changed my opinion on that in a year and a half.
So stagflation, you mean that we're going to be reaching a level where inflation's going to be remaining at a slow, steady pace, is basically what you're saying, right?
Yeah.
And by the way, if anyone's gained any value out of this video whatsoever, then please hit the like button. We greatly appreciate that. And definitely subscribe to Neil's channel as well. Really appreciate your time, Neil, on this.
Yeah, you're welcome.
All right, let's talk about the foreclosure and eviction moratorium that's set to expire at the end of the month. First of all, do you believe it actually will expire at the end of the month? Because that's been extended, I don't know, what, 7-8 times since this pandemic began?
Yeah. I mean, the challenge with the US market is that it is not simple like the England housing market or as we say, the UK housing market. Yours is very regional. It's state by state. You have a governor of each state, things like that.
Yeah.
So what I would say, I really do think that it will, for the country as a whole, expire. But I think you're going to see some states and some cities, New York, for example, or LA, San Francisco, the wild cards, the problem childs for the United States, as we would say. You're probably not going to see that occur there. Or if there is, there's going to be some sort of, local government plan to overturn that and they'll do their own or something like that. But yeah, I do think it will because, again, let's look at the patterns. If you look at what happened in the UK, you look at what happened in other European countries and other Western countries, when they said that was going to expire, it did expire.
Oh, interesting.
Now, yeah, now the one that's different to that is the furlough program, which is completely different to what we're talking about here. But that's the one where almost every country said it would expire and then they extended it. So they're very different. But with the rent moratoriums and evictions and things like that, these tend to have expired on the day they've said.
Interesting. Yeah. And so if it actually does expire at the end of the month, which, you know, the White House says it's going to, if you go onto, I think it was the CDC's website, they say, we intend to end it on this date. And then before that, when they announced all the moratorium extensions, it was like up until, and so it just left it open. So yeah, if it actually does expire end of the month for the foreclosure and eviction moratorium, how do you think it's going to affect the housing market? Any opinion about that?
Yeah. So how will it affect the housing market? I don't see what a lot of, again, housing market YouTubers see. So what you're seeing with a lot of them and what they're saying is that this is going to cause a collapse or a huge crash and I saw one guy said a 45% correction in the housing. And I'm like,
in 1 year?
No. Yeah.
I'll bet him like, money if you send me his channel that it will not that will not happen.
It can't happen because it isn't a big enough body of houses to affect that size of a crash. So, I mean, I think we're going to see some softening, to use a realtor Zillow word there, because that's what they love to use, softening. And, they use all this very descriptive language. So I think it's going to have some of sort of an impact, but I don't see the impact that they're seeing. 3-4% impact on not house prices coming down, but the market in general. Inventory. It might affect things. Yeah, it could be inventory. It could be some landlords simply want to sell, especially in those aforementioned cities and certain states, because they're like, do you know what? I can't trust my own governor or whoever to actually give me a good deal here and do the right thing and do the honorable thing. And by the way, I'm not getting into the politics and the ethics of evictions and things like that. I'm purely talking about it from a mathematical monetary perspective, in that someone has followed all the rules and all the laws, and they've got, let's say, a rental property that they're renting out to, and they've done everything right. They're a good person. They've rented it out. And yet they can't do anything. They can't, evict if someone's not paying. And here's the example I'm using here. Some of the people that are not paying, they can pay. They're just like, I choose not to pay. And that's weird. Same with
forbearances.
Same with forbearance. This is weird to me because you don't really see this in Europe. Like the American mindset, the European mindset is very different. So in the UK and Europe in particular, yes, some people might have taken the forbearance that didn't need it, right? Maybe some people, I mean, I'm a broker, I'm a property manager myself. So we have a lot of tenants, hundreds of tenants. And I would say it was maybe 3-4% maximum who said, I can't pay, I don't want to pay or whatever. They hadn't lost their jobs. They were just like, oh, I don't want to pay. But that was it. Now, you compare that to some of the stats from the US, especially in places like San Francisco and LA. And I know these because I studied these markets in depth. And you see the statistics there, people who just say, I just don't want to pay. And, you're like, but why? Why don't you want to pay? Oh, I just, and it's just crazy. Some of the things going on is just weird to me as a European, because we are paying even, no matter what. So
It's interesting. So what have you seen in the housing market in the UK? Like, I guess, how is it compared to what you're seeing in the US? Because I personally don't follow the UK housing market. I imagine a lot of my viewers don't either. But it would be really interesting to see how the US housing market in general compares to the UK.
Yeah, well, I mean, we don't even just need to talk about the UK. You can talk about Canada, Australia, New Zealand, Germany, France, Belgium, anywhere. Any of these Western nations, you're having the same challenges in all of them. And this is due to the advent of globalization. Everything's connected. All the banks are connected. Why did, some of these banks get bailed out during the 2008 crisis? Because they were connected to too much. Why did AIG, the insurance company, get bailed out? Because they're the ones that are supposed to bail out the banks and with the insurance, and they didn't have the currency on hand to do it. Globalization is everywhere now. All the banks are connected, and you're talking about BlackRock and people like that buying houses. Same in the UK. Lloyd's have just announced they're going to be becoming a large landlord in the UK and buying houses. You have it in Australia. There's all these big banks and financial institutions buying houses. it's the same everywhere. And because they're all connected, it's going to cause a massive issue when one of these markets comes down. And the one to really watch is the US market. When that comes down, everything is going to it's going to be, I don't even want to think about it, because it's scary what will happen global when that comes down. And anything could cause this, Jason, anything at all. You have the stock market, very shaky indeed. I mean, when has the stock market ever grown, like exploded up in value in the time of crazy crashes in GDP? Housing market gone up when people are losing their jobs, and we have a jobs crisis in the United States as well. Yeah, it's worrying, all of these sort of developments. But specifically on your question, then, the UK market is very different because, it's the same. They're all the same, and that is low inventory, low interest rates, etc., etc. A lot of red tape on building. The UK is a small island, so you can't build as much. We have a lot of greenbelt land, which is like what you would consider national park, nature reserve, things like that. You can't build them. Yeah. So, and it's difficult to get permits. So it's very different. And you have similar with New Zealand and other places as well. So they're all the same in terms of the fundamentals. Now, the UK is different in a few things. We have the stamp duty. When the holiday ended, I said this is when we're going to see a few issues in the housing market. What do you mean the holiday ended? What do you mean by that? Okay, so stamp duty was it was called a stamp duty holiday. So this means that if you buy a house in the UK, you pay X% dependent on the value of the house. It's like a tax when you buy a house. Okay. So when you actually, like a sales tax, almost like. Yeah, a sales tax on buying a house. And is that something new, or is that something that's always been in place? It hasn't always been in place, but it's been in place for a while, and it's it's outrageous. Yeah, it's outrageous. No one. So is that percentage like change based on like the location or like the home price, or how's that all work? Yeah, it's purely based on the home price. Yeah, regardless of where the neighborhood is or whatever. Yeah, regardless. Interesting. Yeah. Sorry to interrupt you. I never heard of stamp duty before for housing. Yeah. Oh, okay. So yeah, it's a sales tax. And one of the things I really don't like about the UK tax system, it's outrageous. I won't even tell you my tax rate. You, like American people you'd faint. I think you'd just faint if you found out or how much tax I pay and how much I get to keep. And it's a slither. Everything from my gas. I'll tell you something crazy as well. When I go to the US and I'm there, a few months every year, I love the fact that the gas prices are so cheap. Now, they've exploded in the last year. In the UK, if you buy, let's say you buy $1 worth of gas, right? Equivalent. We don't use gallons, we use liters, but let's just say you buy $1 worth of gas. They actually they put a tax, a lot of it's tax on that $1 worth, a lot of it's tax. And then do you know what they do? This is how crazy it is. They then put a VAT, a sales tax, on top of the fuel tax. Do you get what I'm saying? So it's like, I don't know what it is. It's probably interesting. Okay, you pay sales tax on gas. Okay. Yeah, and on the fuel duty, the fuel tax as well. And that's baked into the price of the actual gas, right? $1 per liter, right? Interesting. Yeah, and it's 20% sales tax, by the way. Wow. It's not 5-6% like you have. It's 20% sales tax. Is that just on gas, or is that just across the board for all goods? Across the board. The only thing 20%. Wow. You've got it good. I think it's about 8.75% where I live. That's a lot. A lot less than 20% though. Yeah. So getting back. So stamp duty then. So there was a holiday, what you would say, a vacation from paying this sales tax, if you want to call it, a stamp duty on the house. So you had this huge run up in the UK housing market. Everyone just was like, buy. They were buying everything. I mean, they were literally buying whatever they could get their hands on. It was, you've seen the bidding wars in the US. Times that by 2, and that's some of the things you'd see in the UK. So everyone was able to have that waived, which is interesting because in the US, obviously we have first-time homebuyer program where maybe there might be some sort of credit involved, and you have to be definitely have to be a first-time homebuyer. So you're saying across the board. So tell me a little bit more about that stamped duty tax. Like, how much is it people actually have to pay in order to buy a house? Like, what's that tax look like? Yeah, so it's actually not a simple thing to explain, because you've got 5 different categories. Is it your main residence? Is it a rental property? Is it your second resident? You know, all this. But the top rate is like £1.5 million, and that's about 15%. 15%. Yeah. And then at the low end, it's 0% on anything under, I don't know, £250,000 or something like that.
That's a huge amount, and it especially applies to everyone. I mean, just people must be wanting to buy houses left and right there.
Yeah, well, you know, we're a nation of homeowners. The UK, a lot of Europe is. I mean, somewhere like Romania, I believe, has the highest level of home ownership, just off the top of my head.
Interesting.
But yeah, the UK has gone through cycles, because we still have these, you know, these classes: lower class, middle class, upper class. We still have the class system, which you don't. I wouldn't say you don't have in the US.
Not a formalized one.
No, I believe you do have it. It's just hidden. But yeah,
definitely makes sense. All right, well, let's wrap this up here in a little bit. I have one more question to ask, and then if you have any questions too, we can throw it all out there. Sure. But I was curious, like, I mean, you seem to really follow like data very closely, and that's what you gauge like your housing market updates based on, which is exactly what I do. So what stats in particular do you actually track in order to gauge the temperature of the housing market, or anything that you track in particular to kind of like gauge about, you know, is the housing market kind of slowing down here? What do you actually track yourself?
So really, really simple. I track interest rates, so mortgage interest rates, Fed interest rates. I track inventory levels, and then I really track the home buyer sentiment. So I'm looking at, these are the main things that I'll look at, and I'll look at the average house price, obviously, and new build, the price of new builds as well.
Interesting. Yeah. Okay. So you ever look at like mortgage application numbers? Is that something that you're concerned about at all, or something you just don't simply track? Yeah,
I do look at it, but I don't let it sort of influence it. The stats a huge amount, because where you're seeing a drop there, you're seeing increases in cash buyers, or you will see an increase in the big funds, BlackRock and things like that. So I think people rely on things like that too closely, when there's a lot of other variables that come in, that a lot of them you just can't see until they've already occurred. So people say, you know, what you just mentioned there, they say, oh, because of this is going to cause, you know, this downturn or whatever. And, you know, there's some guys that talk about a downturn every day on their channel and a crash every single day, right? And then you look at the data and they'll say, Q4 of 2021, there's going to be this huge crash of 60%. You're like, sorry, what? Did you just say 60%? What are you looking at? Oh, when the forbearance and the moratoriums end. No. Let me just be really clear on one thing. When the forbearance ends, the banks, like the mortgage companies, they do not want to take on all of these loans. It's too much hassle. Yes. Like 10,000, they're talking about they have to deal with 10,000 a day towards the end of the year of people who are having difficulties. The staffing alone would just wipe out any value that they could get by getting the housing back and reselling it. And it's too much hassle. That's not their business. Their business is a money lender. So they don't want to be dealing with all of this. I personally think because of the amount of value, the equity that's been added over the last year or so, there's not many houses that are going to be underwater. In fact, I think you'll struggle to find many at all that are underwater, which means negative equity, sorry. Yeah. So I just don't think you're going to see this big wave of foreclosures. Yes, you're going to see some foreclosures, but it's not going to be enough to cause a housing market crash. What I see, because this is the question you asked me at the start, and I'll come back to it. What I see causing a housing market crash is when interest rates go up by a significant amount. That's what I see. Or there's a stock market crash, or there's something that occurs and it creates a knock-on effect. And we have something similar to what happened in 2008, where all the banks are connected and globalization. I see something like this causing a crash. Now, this is very hard to forecast and predict, because if the Fed raises interest rates, well, why would they? Because they want to just keep QE. That's the easiest thing for them to do. But if they raise interest rates, they're going to pretty much bankrupt the government. And this is the same in most countries where you're reaching 100% debt to GDP ratio now. So it's known as a liquidity trap. Japan have been in it for 20 years, actually. If you want something to study, look at Japan. The bottom line is it's not as simple as a lot of people make out in terms of what's actually going to happen. There's too many variables for one human being to be able to calculate in their head. You need a lot of models, and even then, they're only as good as the input and the data you give it
on that day. Pretty much, right? That way makes it, I think you hit the nail on the head there, because there's so many variables involved. You hear people saying that, oh gosh, the mortgage applications decreased by 24% compared to last year, whatever it is. But you have to take a hard look at, what happened 1 year ago, and how is that, similar to what has happened in years past, right? So you had the stay home orders that were issued in March through April, which affected people looking at houses then, which of course affects home sales 30 days later, because it takes about 30 days to sell a house from when you accept an offer to when it closes escrow. And so, I personally don't look at a lot of the year-over-year numbers, but I'm sure there's a lot of YouTubers out there that, focus on one number and say, oh, like the, I don't know, sales are down a lot compared to 1 year ago, or pending home sales are down a lot compared to 1 year ago. Well, duh. I mean, after the stay home orders were lifted, and then people had these new work at home arrangements where they can live virtually anywhere they want to, then that allow them to purchase houses elsewhere and not focus on the, 1 block away from your office that you want to walk to or whatever. And so I would advise people really that are looking at what's going on in the housing market to, when you're looking at month to month, look at long-term trends, and then on a year-over-year basis, look over what actually was going on in the world, in the economy, in that local market 1 year ago, because comparing now to 2020 is like comparing like apples to oranges. And that's going to be throughout the entire year, because last year home prices increased for virtually the entire year, and the housing market was in full swing. So we're going to see a little bit of a lull period this year if we have some more of a normal market. But when you look at the year-to-year numbers, it's going to look like the housing market's totally crashing compared to 2020. I personally would love to see more websites showing comparisons to 2019, which would be great. I know Redfin does that. Agents are not big fans of Redfin, but they actually have some really good data to share there based on what happened, what's going on now compared to in years past, not just 2020. That's my take.
There was one other point I was going to make, and I can't remember what it was now. It'll come back to me in a second.
I probably was talking too long, Neil. I apologize.
I come up with ideas as you're talking, but I'm like, after a while, it's like, oh, it's gone. I'm on to the next thing.
I do the same, yeah.
Just on that, Jason, actually, one point. One thing I've noticed, apart from the data that's come out this week saying new home sales have dropped, 19.1% or something
year over year,
Yeah, which is, what you're saying is it correlates with what you just said a moment ago. One other thing I've noticed is, I don't know if you have alerts set up, but I have alerts set up for different regions and when there's listings and when there's price drops and things like that. In the last 2 weeks, I've noticed a lot of reductions in prices.
Interesting.
I mean, a lot, double what I've noticed over the last few months.
Yeah.
So that's something that I definitely think I'm going to have to analyze this week and look at why that is. Now, personally, it's probably something as simple as a lot of realtors were saying, you can list for whatever you want. Okay, what's the Zillow price prediction on it? Okay, well, Zestimate, that's the one. Why don't we just put that up by 50K and let's see what we get? And now they're saying, okay, no, we're not going to get it. There is I do believe there's a slowdown in buyers right now, definitely from what we saw. So I don't, but again, it's regional. It depends on the area. So I do think a lot of realtors are saying that, okay, yeah, we didn't get it, so let's just drop it down because there's so many other houses on the market and we need to remain competitive and we don't want it to sit there for too long because, all these other reasons. It's for sure. The housing market's psychological. Yes. So yes, it's regional, but it's also psychological. So what will probably change it as well is the psychology of the, there is a phenomenon which is group thought. It's not really talked a lot, especially, YouTube and economics and things like that. But it does exist. There is a phenomenon in group thought. And it was tested, it's proven a lot of times. It was proven when Princess Diana died in the UK and, all the experiments in the labs and the universities, they stopped working. It went off the charts. 9/11 was another time in human thought and things like that. And a lot of people don't really understand that this phenomenon exists. And when you have the media as well wrapped into this, and they start putting out articles like cryptocurrency. Look what happened with the cryptocurrency market. They start putting out all these articles, and then, oh, coincidence, the governments and everyone, they're all doing the same articles and things at the exact same time. Is it coincidence? Maybe not. So I think a lot of it's psychological, and what they want to do is they want to lead things in a certain way. So that could be housing markets, stock markets, things like that. And I think when you have this group thought that changes, whether that's naturally or whether it's via the media, you can also see a turnaround in confidence in the housing market. And that is the wild card as well, which I probably should have threw in earlier, which could also affect things. So, yeah, there's a lot going on here.
No, it's definitely true. I mean, you made a valid point there. I don't talk a lot on my channel about, but the media, when you see a bunch of news reports saying that houses are selling faster than ever before and home prices have reached record highs for, whatever, 4 months in a row, then it gives us illusion, true or not, that you could list your house for any price you want, and someone who's going to buy your house all cash, because 1 out of every 4 transactions in the US is all cash, right? So you might as well ask for the moon. And so I'm personally seeing some overzealous sellers as well, where, hey, I want to list my house for X dollars, and you look at the comparable sales going, I don't see anything that supports this value. And buyers nowadays are still smart. They're not going to be paying way over the asking price. I mean, sometimes, obviously, but if the home is already overpriced, then buyers are cognizant of that. And especially in today's market right now, because in the summer months, we tend to have a little bit of a lull in our housing market, especially this year, in my opinion, because last year, not a lot of people were able to travel a whole lot due to the pandemic. And then, of course, this year, we have a lot of stimulus that went out. A lot of people were saving money, and so a lot of people are on vacation and whatnot. And so during this time of year, we normally see inventory increase, and then houses are sitting on the market a bit longer, but we won't see the days on the market reflected until probably like July or August, because those are closed sales. Any case, so yeah, it's going to be interesting to see how the rest of the year plays out. So I'm really excited to see what's going to happen. And I'm definitely going to be tuning in on your channel, and invite everyone else who's watching this video who hasn't subscribed to your channel already, like I have a long time ago, then please subscribe to Neil's channel and help him reach 286,000 subscribers.
I think I'm too off.
Yeah, I'm sure by the time this interview is over, then I'm sure you probably have already reached it. But let's help him get to 300,000. How about that? Yeah, so Neil, I really appreciate your time. You were the guru when it comes to the housing market, anything business related on YouTube. So I really appreciate your time, and hope a lot of the viewers who are watching right now got a lot of value out of this video. And of course, if you did, hit the like button, and of course, share this video as well. So with that said, anything you want to add, Neil?
No, that's it. Thank you so much for having me on, and really appreciate it. Maybe we'll talk again.
Yeah, absolutely. Let's do this again. Appreciate your time. And everyone, we'll see you on the next video.